What if I told you the secret to building massive wealth isn't some complex formula hidden in the stock market, but a set of disciplined habits the world's most successful investors live by every single day? So many people think they need a lucky break or some insider tip to get ahead. But the hard truth is, most are losing money to common, completely avoidable mistakes. They're gambling when they should be investing, driven by headlines and hype. In this video, we're pulling back the curtain on the 10 core habits that separate the ultra-wealthy from everyone else. These aren't secrets, they're systems. And the best part? You can start using them today to build your own generational wealth. Let's get into it. Habit number 1. They are continuous learners. The first habit, and you could argue it's the most important, is that successful investors are relentless, continuous learners. They never stop. The average person thinks that once they learn the basics, what a stock is, how to buy an ETF, their education is complete. They might watch the news, catch a few headlines, and think they have a pulse on the market. This is a critical mistake. It's like a doctor who stops reading medical journals after graduating. The field evolves, and so must your knowledge. Successful investors, on the other hand, treat knowledge as their single most valuable asset. The legendary Warren Buffett, for example, reportedly spends up to 80% of his day just reading and thinking. He's not staring at blinking stock charts or frantically trading. He's reading annual reports, industry publications, and books to understand businesses on a fundamental level. He famously said, "Read 500 pages like this every day. That's how knowledge builds up, like compound interest." This habit isn't about finding the next hot stock tip. It's about building a deep foundational understanding of how real value is created. It's about understanding industries, competitive advantages, and the quality of a company's management. This continuous learning is the ultimate form of risk management. The more you know, the less you're speculating, and the more you're making informed decisions. The best investors don't just invest their money. They invest heavily in their own financial education every single day. Habit number 2, they have a long-term vision. The second habit is simple to understand, yet one of the hardest to actually practice. They have a long-term vision and unbreakable patience. The biggest problem for most investors is the constant noise. Financial media is literally designed to create a sense of urgency. This stock is soaring. Is the market about to crash? This short-term chaos triggers our worst emotional impulses, causing people to chase hype or panic sell at the exact wrong times. They're trying to time the market, a game that almost no one wins consistently. Highly successful investors operate on a completely different timescale. They think in decades, not days. They understand a powerful force that the impatient ignore, the magic of compounding. Like planting an oak tree, they know real growth takes time, and the biggest rewards come at the end. The data is overwhelmingly clear. Time in the market beats timing the market. In fact, studies have shown that missing just a handful of the market's best days over a couple of decades can slash your total returns in half. These investors see stocks not as blinking numbers on a screen, but as ownership in real businesses. Think about it. Would you buy a local coffee shop and then sell it a week later because of a bad weather forecast? Of course not. You'd focus on its long-term success. That is precisely how the best investors view their portfolios. They buy with the intention to hold, giving their quality investments the time they need to mature and compound. Habit number 3, they conduct thorough research. The third habit separates true investing from pure speculation. They do exhaustive research and due diligence. The most common mistake amateur investors make is acting on a tip. They hear about a can't-miss stock from a friend, a social media influencer, or a TV pundit and jump in, terrified of missing out. That isn't investing, it's just gambling on someone else's opinion. You have no idea why you own it, which means you'll have no idea when to sell it. In contrast, successful investors are like financial detectives. Before a single dollar gets invested, they roll up their sleeves and do the hard work. This is called due diligence. They pore over financial statements, the income statement, balance sheet, and cash flow statement. They analyze the company's business model, its competitors, and its potential for growth. They even study the management team, looking for integrity and a smart track record. Legendary investor Peter Lynch was a master of this. He popularized the idea to invest in what you know, but his philosophy went way deeper. It wasn't just about recognizing a brand, it was about using that familiarity as a starting point for a deep investigation. As Warren Buffett says, risk comes from not knowing what you're doing. Thorough research is the antidote to that risk. It builds the conviction you need to hold an investment through shaky times and to ignore the dangerous allure of hot tips. They don't just buy a stock, they buy a business they understand inside and out. Habit number 4, they master their emotions. This brings us to the fourth, and perhaps most challenging habit. They maintain ironclad emotional discipline. Investing is a psychological battlefield. The two most powerful emotions, fear and greed, are the primary enemies of your returns. Greed, often showing up as FOMO, the fear of missing out, tempts you to buy into overhyped assets right at their peak. Then when the market turns, fear takes over. It creates panic, causing you to sell at the bottom, locking in your losses and violating the #1 rule of investing: buy low, sell high. Year after year, studies show that the average investor underperforms the market precisely because they let these emotions drive their decisions. Truly great investors have learned to master this internal battle. They operate on logic and process, not on impulse. Warren Buffett's famous advice says it all: be fearful when others are greedy, and greedy when others are fearful. It's a simple concept, but it requires incredible emotional strength. When the market is euphoric and prices are skyrocketing, the disciplined investor gets cautious. And when the market is plummeting and fear is everywhere, like in 2008 or the 2020 flash crash, they see opportunity. They view market downturns not as a crisis, but as a sale, a chance to buy wonderful businesses at a discount. This emotional stability doesn't mean they're robots. It comes from having a solid framework. Their research, their long-term plan, and their clear goals act as an anchor, keeping them steady when the emotional storms of the market start raging. Habit number 5, they practice intelligent diversification. The fifth habit is a core principle of risk management that the wealthy never ignore: intelligent diversification. A common mistake is putting all your eggs in one basket. An investor gets convinced that a single stock or a crypto coin is the one and bets the farm. This exposes their entire financial future to the fate of that one asset. It's a tightrope walk without a safety net. Now, it's true that some legends like Warren Buffett have built fortunes on highly concentrated portfolios. But let's be clear, they only do that after an insane amount of research gives them near absolute conviction. For the other 99.9% of us, successful investors prepare for the future by diversifying. This means spreading investments across different asset classes, like stocks, bonds, and real estate, that don't always move in the same direction. Within stocks, they diversify across different industries and parts of the world. But the goal isn't just to reduce risk. It's also to create a smoother ride, so that when one part of your portfolio is down, another part might be up, helping you stay the course. It's important to avoid what Peter Lynch called diversification, owning so many things that your winners get diluted into mediocrity. The key is intelligent diversification, owning a collection of well-researched, non-correlated assets that work together to optimize your returns over the long haul. Habit number 6, they set clear goals and make a plan. Habit number 6 is the foundation for everything else. Successful investors have clear, specific goals and a written investment plan. Most people approach investing with a vague desire to make more money. But that's like setting sail across the ocean with no destination in mind. You just drift, pushed around by the market's currents, with no way to measure progress or make coherent decisions. The world's best investors start with the end in mind. They know exactly what they are investing for. Is it for retirement in 25 years? A down payment on a house in 7? Their kids' education in 15? The goals are specific, measurable, and have a deadline. Then, they create a formal investment plan, usually in writing. This document is like a constitution for their financial life. It outlines their goals, risk tolerance, target asset allocation, and the rules they'll follow. Why is a written plan so powerful? Because it's your anchor in an emotional storm. When the market is crashing and your gut screams, "Sell," your plan is the rational voice reminding you of your long-term goals. When a friend is bragging about a hot stock, your plan keeps you disciplined. Studies show that investors with a written plan have more confidence and are far more disciplined. They aren't just investing, they are executing a mission. Habit number 7, they regularly review and rebalance. The 7th habit makes sure that a carefully built plan actually stays on track. They regularly review their portfolio and rebalance when needed. There are 2 equally damaging approaches here. The first is obsessive checking, staring at your portfolio multiple times a day, reacting to every little blip. That's a recipe for anxiety and bad decisions. The second is complete neglect, setting up a portfolio and ignoring it for a decade. This can be just as dangerous. Successful investors find the healthy middle ground. They schedule periodic, unemotional reviews, maybe quarterly or once a year. The point isn't to second-guess every decision. It's to check if the asset allocation is still in line with the plan. Over time, some assets grow faster than others. For example, a great year for stocks might shift your portfolio from a planned 60% stock allocation to 75%. That portfolio drift means you're now taking on more risk than you intended. The solution is rebalancing. This involves selling some of the assets that have done well and are now overweight, and using the money to buy more of the assets that are now underweight. It's a powerfully disciplined and automatic strategy. It forces you to do what's emotionally hard, trim your winners, and buy more of what's on sale. It's a systematic way to sell high and buy low, keeping your portfolio aligned with your goals. Habit number 8. They invest in what they understand. The 8th habit is a simple guardrail against speculation, famously championed by Warren Buffett and Peter Lynch. They stay within their circle of competence. The financial world is full of complex, alluring products, exotic derivatives, triple-leveraged ETFs, obscure cryptocurrencies. There's always something new and sophisticated. The problem is, many people get sucked in without the faintest idea how these things actually work. Great investors operate on a simple principle. If you can't understand it, don't invest in it. Peter Lynch had a great rule of thumb. You should be able to explain the idea behind a stock to a middle schooler in 2 minutes or less. If you can't, you don't understand it well enough to own it. Your circle of competence is simply the set of businesses and industries you can genuinely analyze and evaluate. For one person, that might be tech companies. For another, it might be retail brands or banks. This isn't about limiting yourself, it's about knowing your limits. It's admitting you don't need to be an expert on everything. You just need to deeply understand the few things you choose to own. Staying inside this circle dramatically reduces risk because your decisions are based on knowledge, not hype. It gives you the confidence to hold firm when the market disagrees with you and provides a powerful filter to tune out the noise. Habit number 9. They invest consistently and automatically. Habit number 9 is the engine that actually builds the wealth, brick by brick. They make saving and investing a consistent, automatic habit. Many aspiring investors fall into one of 2 traps. First, waiting for a big lump sum of money, thinking they need a fortune to even start. Second, waiting for the perfect time to get into the market, trying to pinpoint the absolute bottom. In both cases, the result is the same: inaction. They lose their most precious asset, time. The most successful investors treat investing not as a one-time event, but as a recurring, non-negotiable habit, just like paying the mortgage. The most effective way to do this is through automation. They set up automatic transfers from their paycheck into their investment accounts on a regular schedule, every week, every 2 weeks, every month. You've probably heard of this. It's called dollar cost averaging. By investing a fixed amount of money at regular intervals, you automatically buy more shares when prices are low and fewer when they're high. This does two critical things. First, it takes emotion completely out of the equation. You're no longer trying to guess if now is a good time to buy. The system decides for you. Second, it builds discipline and consistency. This simple, automated habit is one of the most reliable and stress-free paths to building significant wealth over time. Habit number 10. They are obsessed with minimizing costs and risk. Finally, the 10th habit. It's often overlooked, but it has a massive impact on your wealth. Successful investors are relentlessly focused on minimizing costs and managing risk. The average investor often ignores the fine print. They're so focused on potential returns that they don't pay attention to the small fees, expenses, and taxes that are silently eating away at their money. These silent killers can be devastating over time. Think about a 1% annual management fee. It doesn't sound like much, but over 30 or 40 years, it can consume a staggering portion of your returns, sometimes up to a third of your final nest egg. It's like compound interest working against you. Successful investors get this. They favor low-cost index funds and ETFs, they're mindful of trading commissions, and they structure their portfolios to be tax-efficient. Beyond just costs, they are masters of risk management. They don't see risk as just market ups and downs, they see it as the permanent loss of capital. They manage this through proper asset allocation, diversification, and by investing with a margin of safety, buying assets for significantly less than their estimated intrinsic value. By focusing just as much on protecting the downside as they do on capturing the upside, they build resilient portfolios that can stand the test of time. So, there you have it. The 10 core habits that are the bedrock of long-term investment success. Let's do a quick recap. They are continuous learners. They have a long-term vision. They do their homework. They master their emotions. They diversify intelligently. They plan meticulously. They review and rebalance. They stay in their circle of competence. They invest consistently. And they are obsessed with minimizing costs and risk. Notice that none of these require a genius-level IQ or a secret algorithm. They are about discipline, patience, and committing to a proven process. These are the principles that build not just wealth, but generational wealth. And the best part is, you can start building these habits right now. If you got real value from this breakdown, do me a huge favor and hit that like button. And make sure you subscribe and turn on notifications so you don't miss our next video. Finally, I want to hear from you. Comment below with the one habit you are going to commit to building starting today. Thanks for watching, and let's start building.